In early August 2024, a panic swept through global markets. Across multiple time zones and asset classes, heavily interconnected financial structures violently unraveled. In Japan, the damage was historic. On August 5th, the Nikkei 225 index plummeted 12.4% in a single trading session, wiping out billions in value. The trigger for this massive global sell-off was surprisingly small. The Bank of Japan raised its core interest rate by just 0.25%. For Thai investors, watching currencies swing wildly and capital flee across borders triggered immediate flashbacks to the financial collapse of 1997. But the mechanics of these two panics are entirely reversed. In 1997, a local economy imploded. In 2024, global capital suddenly retracted. In the mid-1990s, Thailand was booming. The country aggressively sought to become a regional financial hub, boasting double-digit growth and massive foreign investment. This flowchart visualizes the trap they built. Thai corporations borrowed massive amounts of cheap, short-term US dollars. Because the government guaranteed a fixed exchange rate, companies felt safe converting those dollars into baht to fund long-term domestic real estate projects. As you can see, that rigid barrier eventually shatters. When Thai exports slowed down, currency speculators attacked. The Bank of Thailand drained its foreign reserves to zero, trying to defend the peg, until it finally snapped in July 1997. Floating the baht meant the local currency lost half its value. Overnight, the cost to repay those foreign loans skyrocketed. Businesses went bankrupt instantly, leaving massive half-built projects abandoned across the Bangkok skyline. The 1997 crisis was a self-inflicted wound. Thailand borrowed foreign money to build locally, and the structure collapsed the moment the currency peg failed. Over in Japan, the macroeconomic strategy was entirely different. To fight off decades of deflation, the Bank of Japan held its interest rates near zero and occasionally below zero for 30 years. This visualization tracks the resulting strategy, known as the yen carry trade. Global investors borrowed virtually free Japanese yen, converted it into US dollars, and deployed it abroad. Notice how the capital flows outward. That borrowed money flooded into high-yield global assets, heavily inflating pools of US tech stocks, emerging market bonds, and cryptocurrency. The catalyst for the unwinding arrived when global inflation finally reached Japan between 2022 and 2024. The central bank was forced to raise rates, causing the yen to rapidly strengthen. The visual reverses violently here. A stronger yen meant those nearly free loans became instantly more expensive. Investors faced massive margin calls, forcing them to urgently liquidate their global assets just to buy yen and pay back the banks. It is the exact inverse of 1997. Investors borrowed local Japanese money to invest globally, and the system broke down when the cost of that local money finally began to rise. The 1997 crisis largely contained its initial devastation to Asian economies. The yen carry trade, however, is heavily embedded in global markets. As the trade unwinds, it drains liquidity worldwide. Borrowing costs spike, forcing violent, synchronized sell-offs in major foreign exchanges as investors scramble for cash. For Thailand, the direct mechanism is capital flight. Japanese investors and global hedge funds are forced to sell off their Thai stocks and bonds to repatriate funds back to Tokyo. This sudden global retraction forces money out of emerging markets, creating immense volatility for currencies like the Thai baht, regardless of local economic health. So, is Thailand facing another 1997? The short answer is no. Today, the Central Bank holds over $200 billion in foreign reserves, and the currency floats freely to absorb shocks. The defenses are strong. The real, current danger exposed by the yen crisis is entirely different. Thailand is stuck in a chronic, low-growth trap. Economic expansion is sluggish. The country struggles with low global competitiveness, household debt exceeding 90% of GDP, and a rapidly aging society that strains the labor force. This creates an impossible dilemma for policymakers. Cutting interest rates to help struggling locals risks accelerating capital flight. But raising rates to protect the currency crushes local borrowers who are already drowning in debt. The explosive ghost of the 1997 implosion has been defeated by modern financial safeguards. In its place is a slow-burning, chronic vulnerability, leaving Thailand deeply exposed to the whims of global capital retractions.